Hey guys, hey everybody. This is Ed Bugos here from the Dollar Vigilante. We've got some guests with us, Mike Benke and Josh Thompson. They're part of my team, and we've got a special guest, Kevin Duffy, on as well. So we just wanted to have a general podcast today about mostly about where the stock market is, and we've had a bull market in stocks for I mean, we can argue about chopping it up into several bull markets, but I think most people will agree that post 2008 we've had one pretty big giant bull market, with some interruptions in between, and so we want to talk about where we are in that cycle, and whether investors have any reason to worry about any of it, right? So maybe Kevin, if you want to just tell us a little bit about your background, a little bit about what you do, where you're from, and we can start and go from there.
Sure. I'm in Southeast Pennsylvania, and I actually do two things. I write a newsletter called the Coffee Can Portfolio, which I started about 4 years ago. And I also manage a hedge fund. The way you and I met, Ed, was through the Austrians in Finance chat group. So that's really what we have in common, is applying that Austrian non-interventionist framework to everything that we do.
Yeah, I think we don't.
I would describe what I do is.
I was going to say, Kevin, I think we know all the Austrians in finance.
Yeah, that's true. I think we do.
Yes, it was a pretty.
Yeah, the numbers getting bigger. That's for sure. Yeah.
Yes. Sorry, I interrupted you.
So no, I think I would call myself, part Austrian, part definitely a big part contrarian. And so I like to kind of start with the big picture, but also, I'm a stock picker. So, looking at things from not only the macro 10,000 foot level, but also, getting into business economics and competitive moats and things like that are, of course, very important. And also, I'm very much a generalist. So I cast a very, very wide net. And I think that's a big part of. I always feel like there's always an opportunity somewhere. That if you don't think that, then you're just not turning over enough rocks.
No, 100%. That's something that I've used to try to condition my clients to when I was way back in the last century as a stockbroker. I had tried, because people look at deals and they think, well, if I miss this, they get the FOMO, right? I got the fear of missing out on something, and you got to tell yourself that there's always something else going to be around the corner. So it's never look at these things as if this is your last chance, because that immediately puts you at a disadvantage, right? I think.
Yeah, absolutely. And I think you have to be patient. This is what I like, is that if I'm looking at enough things, there's always something to do. So I don't have to feel like if you get too overly concentrated, you run the risk of always waiting for that wave to carry you. You're just constantly. It's kind of, you suffer, I think, a little bit from when all you have is a hammer, everything is a nail, and you can get into this sort of tunnel vision. So that's why I like to cast this wide net, and I think it provides a little bit more balance.
Mm-hmm. Interesting, but not too much diversification, right? I mean,
not over diversification. No,
yeah.
It's just like finding that right balance.
Right. There's something to be said for concentration. I think I don't particularly do it because it's too stressful for me, but there's something to be said for it in that it keeps you on your toes, right? It keeps you vigilant about your positions, and keeps you, constantly questioning whether when you are concentrated and when you have, I don't like leverage either, but if you have to have leverage, and it's the same sort of thing. If you're concentrated or if you have leverage, you're gonna, you should be vigilant. Let's put it this way. You should be, right? You need to,
Right.
right? So with an approach like yours, or with a less concentrated approach, you could probably sleep better at night, at any rate, right?
Yeah, I think my friend Chris Mayer likes to say, you don't want one bullet to kill you, and so I think the way I look at it is I use the analogy of a game. It's an investment game, and the first objective of the game is to survive. If you get taken out of the game, then you can no longer play the game. So the first thing that I like to do is look at scenarios. What are the possible, you've got the bull market, the bear market, recession, inflation, hyperinflation, all these different scenarios, and then construct a portfolio that if one of those scenarios plays out, it's not going to kill you. And also look for areas in the market that in a scenario could kill you. So for example, let's say, you think that an inflation or a hyperinflation is a possible scenario. Let's say you think that there's a 50-50 chance of a hyperinflation over the next decade. Then you can pretty much take cash off the table. I think it makes your job a little bit easier. Likewise, I think you can take bonds, especially government. Let's envision another scenario. Government. We know all the problems with the $34 trillion in debt and interest expense going up and all this being unsustainable. Well, I don't want to be necessarily lending money to the U.S. government. I think if I look out 10 years, that's going to be a horrible investment. So, that's one of the things I'm doing, is trying to look at multiple scenarios, not necessarily betting it all on one of those scenarios, but making sure that I don't have pieces of my portfolio that are going to get wiped out in any one of those scenarios.
Make it hurricane proof.
Yeah, exactly. And I think that's the first thing that you're trying to do, and then obviously look for the best opportunities, the best investments that you can find. And I think it's also, when you're building a portfolio, it's important to have some non-correlated assets. So you want to make sure that again, we don't know what the future is. We don't know which of these scenarios. I mean, we may have a hunch, and we may be willing to bet a little bit more on one versus the other. But we would, I always like to think of it as, okay, if something happens, especially something that I don't expect to happen, I want some part of my portfolio to do well. I think it allows me to sleep at night. And the other thing is, it allows me to have something that I can sell. Like, let's say we get a extreme bear market. I want to have a little bit of portfolio insurance so that I've got something that I can sell when the bargains come along, that I can pick up, instead of having to sell things they don't want to sell. So
if somebody came to you and said, well, okay, so I'm starting from scratch, got a clean slate, what's the first step that you would recommend that they do in building a portfolio like that?
Yeah, I think, again, the first part is start to think in terms of what the different scenarios are. What are the risks out there that you have to be aware of, and then start to look at what's the opportunity set out there, and how are they exposed to those risks. And I think part of it is fairly simple. It's, where do I find the best values in the market? I mean, that's kind of, I guess, if you're asking for a starting point, that's it. Where are the best values? But once you come up with a list, you have to make sure that that whole list is not all in one place. That and that you're basically betting it all on black.
You mean in one sector,
So,
or do you mean geographically, or do you mean sector wise, or
I mean both. I
no?
mean, geographically, sector wise, thematic wise, different scenarios. So
Do you
an
mix?
example of this would be the United States right now. Obviously, the U.S. equities make up something like 60 to 70% of the world, and we have this bipolarized. We're going into this from this unipolar world. The American, I think of it as an imperial bubble. I think the American hegemony is peaking, and we're going into a very different world. Okay, so do I really want to have all of my eggs in the U.S. basket? I think I want to have some diversification outside of that world.
Mhm. Yeah, I think a lot of our subscribers would agree with that as well. I mean, it's one of those things. The American situation is sort of the last bastion of hope, really, because there's so much depth and intellectually, like there's so much depth in the culture on libertarianism there, that if it's really the world's last hope for defense of liberty. I think even though that there's a lot of places that are not as bad as the U.S. now, and you can go hide there, but when the U.S. goes down, I don't know if it's going to be if there's going to be a libertarian haven anywhere. Maybe in Argentina, I don't know.
Right. Yeah, that's yeah. Wasn't that something?
Yeah,
In Davos, the speech that Millet gave.
yeah, it was terrific.
Did you ever think that we would see something like that?
Well, no,
No.
this is one of the things, because I'm very much of a cynic about politicians, and I don't vote, and I don't
Yeah.
participate in politics. I hate politics. I'm anti-political. But along comes this guy, and it's the first. I'm thinking to myself, like 50 years ago, this wouldn't have worked. There's got to be some progress here, right? So but everybody's spidey senses go off when you gotta when it's too good to be true, right? It's like,
Yep.
oh, this guy's
Sure.
got to be a controlled opposition. He's got to be a deep state agent. I don't know, but I mean, he's waking a lot of people up to authors that have that the deep state has pushed into the shadows deliberately, you know, over the years. So it's it's hard. He's probably going to get co-opted at some point, because let's be honest, shit's gonna get real. Like
Yeah.
when they start, when people, I mean, you already see the protests starting, the union bosses, and unions are not shy to use violence, right? So
Sure.
they're gonna test him to the limits, and we'll see what happens. It'll be fun to watch, I guess. I don't know if fun's the right word, but it'll
Yeah.
be definitely interesting.
Well, it's going to be a lot more fun than what we've been used to, which is not to have any victories
Yeah,
other than Ron Paul
yeah,
in terms of politics.
yeah, and hope, right?
Yeah. Sure.
Yeah. Um, yeah, interesting. So you said something very interesting, Kevin, too, in explaining your approach, is that the risk in government securities, and you know, I've I'm very much, I think that's where the bubble is, of course, and the
Mhm.
dollar. And I agree with you. We have an imperial bubble. I would call it like peak empire, but I would agree with you that that's another way to look at it too, is because there is sort of a rise of, or a revival of warmongering, if you want to
Mhm.
call it that,
Yeah.
right, among the population. So that's not a good thing, and that's manic, right? You know,
Absolutely. Yeah. War is manic. War is the ultimate bubble. The
right?
I think of a bubble as a collective delusion. And
Mm.
I mean,
Yeah.
just the thought of thinking you can solve your problems by going to war to me is delusional. So yes.
Yeah, no, I
You've
like
got the
that framing of a cultural bubble. I hadn't heard that before, and I completely agree. Kind of ties into what your woke index as well, right? Just that
Mhm.
kind of these ideas of just an infected society, but I don't see it as being sustainable. But I think you said something in a previous interview that ideology is a hard thing to shift or something like that. It's a hard thing to shift. So in something like a cultural bubble, would the ideology shift quickly, like when a bubble pops, or like how do you envision that?
Yeah, what did I say? Ideology has very high switching costs.
Yeah, that was it. That was it. Yeah.
Uh, yeah. So I, and because of that, people don't, I mean, once they reach the, whatever the age is, I don't know, 18 years old, 25 years old, 30 years old, at a certain age, people tend not to change. There
Right.
are exceptions, of course. So I don't see it as people changing their ideology. I see it as, the old ideology um, going away and dying, and those people becoming irrelevant, and the newer, younger people that are not infected by the ideology replacing them.
Oh,
Okay,
interesting. Okay.
so and that's it's difficult because when you look at this cultural bubble, it is very young. Uh,
Yeah, it
my
is.
my father is a student of economics and world history, and I rely on him quite a bit for. He's 80. He, he's he's in his late 80s, and so he went through World War II, and he studied this world history, and so I asked him about the younger generation and propaganda, and he says all generations, his generation is exposed to propaganda, and my generation. Um, the difference is that the younger generation is being absolutely bombarded with it,
yeah.
and from everywhere.
It's
So yeah,
for the
it's going to
worst
be a
right now.
challenge. I don't, it's hard to predict how this all plays out. I think that one way is that we just run into a brick wall of economic reality,
And what
and people are forced. I think people don't change for the most part unless they hit rock bottom, and they're forced to. And maybe that's what's going on in Argentina.
Yeah. So it's like we talk about a financial bubble. So if like a financial bubble pops, that could lead the way for the cultural bubble to end as well. If people are put into stress.
so
Yeah, yeah.
what could end the cultural bubble? Is that what
Yeah.
you're asking?
Yeah, what could end it? And are these bubbles interrelated? As one pops, does
They're
that put pressure on the other?
Yeah, they're absolutely interrelated. And so, let's. I'm thinking about the Bud Light. So, I mean, we come up a lot of examples. The NBA and what was going on during the BLM protests, and they were,
Yeah.
uh, um, they were promoting all of this. Well, it alienated their customers, and so just from a financial standpoint, these companies are being forced to make changes, to fire people, so yeah, I think they are related, and I guess that's the good news, especially if we're believers in free markets and economic gravity and economic reality, that we know that those forces will exert themselves. And so, I think your point about them being interrelated is absolutely spot on. The imperial bubble is another one that, and I look at what's going on in Israel right now, and Gaza, and we're starting to see some cracks in the what I think is the Israel bubble.
Mm.
This was impenetrable,
It's true.
and now there are some really huge cracks in that, and so where does this, like, which domino tips over the other domino? It's
That's
impossible to predict that, but
Well,
you can see where politically on the left in the United States, the left is very much on the side of the Palestinians, and of course the government, the Biden administration, isn't really sure quite what to do with this. So what happens first? Is it the pressure from the left in this country, or is it that we run out, we're broke and we run out of money and we can no longer finance Israel, or is it a combination of those things? I don't know.
Well, let me throw something on the table here. So there's the situation where we shift our ideologies, and so the younger we are, the easier that is to do. I guess, and I mean, I've shifted my ideology from conservatism to libertarianism to anarcho-capitalism.
Mm-hmm.
I don't know if that's a big shift though. That's more of a progression, maybe. I guess.
No, it's a big shift.
It's
Right.
a long summer.
But people like Hans Hermann Hoppe, they've made a shift from being socialist to being anarcho-capitalist. That's a big shift, right? I would agree with you that at an older age, it's harder to make those shifts because you become invested in the ideas. The longer that you have these ideas and beliefs, the more of yourself you've invested in them, right? So yeah, I would say that, but so it's kind of a good thing maybe that that the young are getting all this propaganda, because I think there's a chance that they may get disheartened at a younger age and look for answers at a younger age because of it. That gives me some hope, but also there's another aspect to this that I was thinking about when you were elaborating, was that wouldn't you say that there's some people that that are just prone to being manic, and some people that are from even a young age never fall into the crowd groupthink mentality?
Sure. There are definitely different personalities out there, and I guess there's a spectrum of those.
I guess what I'm trying to get at is what do you think it is in the personality that that makes people prone to
Contrarian.
falling into groupthink in general? Not just the ideas it's themselves, but the just being part of a group, needing to get that reaffirmation. That, I guess, that sort of process that creates a bubble, right?
Yeah. Wow. It's a good question. I'm not sure I have the real answer there. I mean, just that some people are definitely they're prone to wanting to be part of the in group, and like you said, I mean, some people are not. Some people are just kind of natural contrarians. I think one of these bubbles kind of feed on themselves, and part of that is that there is this intolerance. The crowd really does take over, and there's an intolerance for any kind of dissent at the peak of the bubble. But I think they still, these things still, they go through cycles. It's just a natural. At some point, the bubble just becomes so detached from reality that it bumps into reality, and it forces a shift. But yeah, I mean, getting at your point and your question, I guess you could look at maybe the educational system. You can look at I don't know whether it's parenting or what. I'm sure there are lots of causes there, but it's kind of, I think of it as just where we are in the cycle. We're in this very strange place right now that is detached from reality, and I guess as a believer in cycles, I just believe that things will change. Things will as I said, economic reality will force change on people, and there won't be any. They won't have a choice, really.
That tends to be a very influential thing, reality.
Yeah. So what are your thoughts
and I think
about?
also, Ed, to your point is that there's an opportunity here for contrarians, for people who are able to extricate themselves from the bubble, and they can maybe see the future a little bit better than others. Okay. Whereas if you have to be part of the in crowd, obviously you're going to get, you're probably going to get it run over. And then the people that are really in at the back of the line in the worst shape are the politicians, and those types of people are really part of the in crowd, and they're going to be the last ones to get the memo. So it is what it is. It's the world that we have. I I don't I don't like to complain too much about irrationality, because it's how I make a living,
Yeah, that's true,
basically.
right? It's true.
So that's just the way I look at it, is let's recognize it for what it is, and see if we can try to protect ourselves, and maybe try to
Imagine,
make a little money in the process.
yeah, how dull and how hard would it be to make money if everybody was rational?
It'd be impossible.
Do you think? Probably,
Yeah.
theoretically,
Sure.
it sounds right. Yeah. Be a very, very efficient market, maybe. Would you say so? Would you say there's a difference, say, between a mania, a bubble, and a boom? In the Austrian school talks focuses in on the boom, on the unsound boom, right? Because it has very specific structure and causes. But that's not what we exactly mean by what we've been talking about, right? We've been discussing the manic side of it, the psychological side, right?
Yeah. So, do you mean like the easy money part of fueling the
Yeah,
artificial
like
boom and the malinvestments that come out of it?
yeah, I'm just asking if you would distinguish between a boom and a bubble and a mania. Like, is there a difference even between mania and bubble?
Yeah. Well, a boom can be very real, and a boom can be a secular, long secular wave trend. It can
Right,
be ignited by, well, look at let's
right.
say Argentina as an example. Let's say that Malay is successful. There will be, especially from the ashes of what is Argentina today, there would be a boom. I
Absolutely,
think,
yeah.
but it would be on a firm, a sound
It'd be a
footing.
sound. It'd be a sound boom, right?
Right,
Yeah,
exactly.
because it's driven by savings and actual,
Hmm.
it's real incentives.
Right, right. Yeah, and then bubble. I think of mania and bubble as essentially the same thing. Do you see it that way, Ed?
I see it as the same thing in structure, but there's something nagging at me that there might be a distinction in degree, like
Okay.
you know, I mean,
Tulip
you could
mania.
say
Yeah, I would go along with that. Yeah, I'd say a mania is something larger than a bubble. Could be something small. A mania would be much
right,
broader participation, public participation.
yeah, and have more intensity and
Yeah.
more delusion and more
Hmm.
irrationality, maybe, I guess. Something that's sort of you can't even hide from because everybody's doing it, right?
Right.
Yeah. Like the COVID hysteria with the masks, right?
Sure.
I mean, that was hysteria in my mind. And so you could say that was a bubble, but you could also say that was a mania, really, right?
And where do you think that fits in with all this, with the everything bubble? How do you see that?
That's the question, right? I think
Cultural, I
um,
think. I think it's cultural. The
I
masks.
think I think there's evidence of
Hmm.
with the everything bubble. I think Kevin was referring to the financial bubble. Is that what you mean, Kevin?
Well, I see the everything bubble as everything. So cultural, imperial,
I
Yeah.
see.
and financial.
I see. I see.
And maybe you could even toss in medical.
Yeah. Yeah. So
So I'll try to answer my own question then.
Sure.
So I see this when you have one of the characteristics of a bubble is you get this, you know, this parabolic blow off. At the end of it, you get this, it's not just a detachment from reality, but it is, this complete straight up, like, you can see the charts going like this, right? And so there's some kind of a catalyst at the end of a long bubble to create this, wild, frenetic, euphoric behavior.
Hysteria.
And
Whatever.
I think that COVID was the perfect catalyst for that. It set everything in motion. We had a long bull market, a financial bull market since 2008. Okay. But and it was fueled by easy money, by zero interest rates. It was fueled by various bouts of economic stimulus and the belief in economic stimulus. And then this little virus comes along, and all of a sudden, it just turned everything into this wild, manic response.
Yeah.
Okay. And it was not only the medical establishment, but it was the economic stimulus. And of course, this all got started under Trump. Later it was a lot of these narratives about, one of them was the BLM protests, this whole idea of systemic racism. So that fits in with the cultural bubble. Okay. And all these things kind of coalesced at the same time into one gigantic blow off. And then also you could add to that the blow off in the bond market. We got this incredible, as right when COVID hit, there was this flight to, air quotes, safety. And the 10-year yield dropped down as low as 0.6%, I believe. Okay, from a high of 15% in 1981. So if we look at that long bull market in bonds, where yields go from 15, down to under 1%, you get this, it was that blow off effect that we got. And that's what created that frenzy. You get this, it's a feeding frenzy, right? That's what creates the very top of the bubble.
Well, contributing to that, Kevin, though, wasn't, I mean, the Basel III guidelines that were sort of implemented after 08. So
right.
Sort of like it was a quiet bank reform, right? They sort of they changed the way they did things, but in quite a significant way. But what I noticed after 08 is that the bank's loan portfolios weren't growing that fast, as fast as their holdings of treasuries. So a lot of the money creation that came in after 08 came in through the banks accumulating U.S. government bonds, because before 2008 they weren't the government was or I should say the Fed wasn't allowed to buy treasuries that were anything longer than a year, I think, or three months or a year. But that changed afterwards, and so there was sort of it was like a huge orgy in buying these long, like you say, the end of the long 30-year bull market or 40-year bull market, whatever it was. And then you finally had this government intervention. You forced all the bankers to put an extra layer of risk-free securities on their balance sheet,
right?
And that brings me to another question about related question, because this idea of risk-free, like every hedge fund manager, everybody who graduates from or has their securities license or finish, any introductory course to any media publication that you read, they always talk about how U.S. government securities are risk-free. And we know why, because they have the printing press, and we know that only matters because the reserve currency actually has that status still. So you take away the reserve currency status, and then of course things change. The then the government securities become risky again, like they are in most countries. But so that's another thing, right? So wouldn't you say that that's a huge delusion, that we've got these risk-free government securities?
I would say that's maybe the ultimate delusion.
Yeah.
And there was so funny. I remember dealing with SEC regulators back. This was about 10 years ago, and getting the lecture about how bonds are supposed to be safe and risk-free. And so I gave them the lecture back that no, that may be what you were taught, but that's not entirely true. So there's really two components. One is it doesn't matter, price matters. Okay, so if you could have, let's say, the Mona Lisa, all right, you have this incredibly rare asset that has tremendous value, but if you pay $1 trillion for it, then you've just introduced a lot of risk. Okay, so when rates when government bonds go down under a 1% yield, that in itself introduces a lot of price risk. Okay, but of course, there are other risks. There's credit risk that has been creeping in the whole time. The 911, since 911, I think that Treasury debt, government debt, has gone up something like sixfold. If you look at the percentage, the interest costs as a percentage of tax receipts, when rates were at 15%, I think it was 23% was consumed by interest expense. Today, rates are at 4%, and we are not too far from that. I think we're at low 20s, like 21%. Okay, so this is the problem, is that they have introduced a tremendous amount of credit risk into the system, all under the assumption that it's always risk-free. Government bonds are always risk-free.
And then now the delusion being that that 0 or 1% interest rates are the norm.
Yeah,
right?
And the rates are, and it's funny. So let's get back to you talked about the banks, right? I think that's maybe an interesting thread that we can take a look at. So in 2008, first of all, the banks got rescued. So what the government provides in terms of a safety net, it always comes with strings, right? So as you mentioned, they're now basically expected to buy government debt, right? At the very time that these risks are creeping in. It's getting the good news is if the bonds go up and they have gains, but the bad news is the credit risk is creeping in all the time. Well, the banks, and so all the regulations, and you probably know this probably better than I do, Ed, the Basel III regulations, they were designed, of course, this was a big embarrassment for the regulators. Of course, they missed what happened with the global financial crisis in 2008. And so they were tasked with trying to design a system that would prevent this from happening again. And so, in typical bureaucrat form, they imagined only the last scenario. And they didn't imagine a scenario where interest rates could go up and they could be sitting on interest rate losses. So the whole system was designed to pretend that this would never happen. So you have the held to maturity accounting, which basically says that you don't have to account for unrealized losses on these treasury, well, not just treasury securities, but mortgage-backed securities. So all this was built into the system, and so when the turn came in, really 2020, 2021, when rates started to go up, I guess it was not in 2021. This was not reflected on bank balance sheets at all. It wasn't reflected in any of the capital ratios. And in fact, Silicon Valley Bank, SVB, was met all of the criteria, even though it wasn't part of the stress test. It still met all the criteria for being a well capitalized
Oh, for
bank.
sure. They tried
You
to
know,
they tried to isolate it and make it sound like as if it specialized in,
yeah,
higher risk loans than the other banks did, right? But and it maybe it did because it was concentrated a
but
little bit in Silicon Valley type loans, right? But yeah, no, that's right.
but what happened at Silicon Valley was, they were doing things by the books because they had. So on the one hand, they had a risky loan book. So
Right.
they had, so the Silicon Valley venture capital type loans. And what they did was they listened to the regulators. They basically used the playbook that the regulators had recommended, and they balanced that with these risk-free government securities. And so they ended up taking on all of this interest rate risk. And when the interest rate risk, when that reared its ugly head, it was basically game over in a heartbeat.
Yeah, look, I think I'm thinking this year with the backdrop of the deflation policy they've had for 2 years now. I think the biggest disappointment this year is going to be that that they won't lower interest rates,
Yeah.
or they won't be able to lower interest rates as much as people think, right?
Yeah.
I think that could be a pin prick to pop that bubble,
Yes.
maybe.
And Mike, you talked about how these bubbles are interconnected. Well, the imperial bubble, part of that is alienating China, and of course, the Chinese are the second largest, I believe, holders of U.S. Treasuries. And so, these things are all connected, and you just wonder, well, like, what it's not going to take much. You start tipping over one of these dominoes, and the Chinese they're not buying any more bonds. They're going to just let these bonds
And
mature.
and when they start their BRICS currency, when they launch that,
Yep.
whenever that is, I mean, they're not going to be buying U.S. Treasuries anymore. Everything is going to go
No.
into trying to support that arrangement, right?
So what are they buying instead of treasuries?
I don't know. I don't know yet.
Well, they'll buy gold.
Yeah.
They
Well,
seem to like
for sure.
gold.
For sure. Yeah. And I mean, they'll
But
probably follow the IMF roadmap of lending, like their infrastructure investments along the Silk Road and parts of Africa and stuff. They've taken that playbook. They've taken that from the U.S. playbook, which the U.S. controls the IMF, right? Which is lend money to these colonies that they know they can never pay back, and then we can control them.
right. Yes. So they're going to try to control them that way with money, with loans, and we're trying to control them with guns, I guess, and
Yeah,
bombs.
yeah.
Neither one is a really good idea. Both
No,
of
no,
them.
no. Yeah, no. I'm not optimistic about the BRICS currency working. By the way, I'm just mentioning that
Yeah.
with a treasure chest full of treasuries ready to launch their own currency, they're gonna be sellers of dollars. They're gonna be sellers of those treasuries to support their currency, right?
Right.
Potentially. I mean, they might not have to for a while, but eventually they will have to.
Mhm.
But they might not have to at first. But that's what their holdings of U.S. Treasuries are going to do. It's going to finance their BRICS currency, right?
Yeah. Well, and it doesn't even have to happen, right? If they just buy fewer dollars at a rate below where they did before,
Right.
that at the margin will have an impact.
Right. That's 100% true. Yeah, a lot of people forget that. A lot of people think, well, the dollar's going to go down when capital inflows reverse, but it's not really necessary because the U.S. runs a trade deficit, so it's all constantly. So it's just a matter of reducing the capital inflows, and then you got a problem, right? More or less.
Now, regarding China, there is a tremendous amount of China bashing going on today, and so that's another
Yeah, tell us about
interesting little
that. I
piece
mean,
to
I know you're
the
bullish. I know
puzzle.
you're. I don't know if you're bullish on China.
Yeah,
Are you? Are you bullish on China, or is it just a
I
safe
guess
haven?
I'm bullish.
Yeah.
It's funny because I used to be, a kind of a grizzly bear on China, and this is when Jim Chanos was, very much bearish on the property bubble and
Right.
all the empty cities and the malinvestment that was taking place. It was kind of like our own housing bubble on steroids, and so it was hard not to be bearish about that, and that definitely seems to be unraveling at this
Right.
point.
Yeah.
Okay, and I think that there is no utopia, there is no ideal economic environment, there's no all the governments are all bad, it's just a matter of degree. And but yeah, what as a contrarian, what intrigues me about China is that everybody hates it. I mean, the West absolutely hates it. It's a very, I love simple narratives. I love when, because this is how propaganda gets spread, is just dumb it down, keep it simple. And you can, you can fit the bear case on China on a bumper sticker. It's the
Yeah.
same thing.
Yeah.
Xi Jinping runs everything with an iron fist, and, it's all top down, and, demographics are horrible. They have this, crazy property bubble. It's, et cetera, et cetera. And, the one thing about China is China's cheap. The stocks have gotten, in the
Interesting.
last couple of years, they've gotten absolutely destroyed. And so, those things are all good starting points. There's a lot more there. And I'll be talking about this at the conference. So,
That's right.
I don't
That's
want to
right.
necessarily
Yeah.
give everything away,
No, no,
but
no, no, no. Keep us guessing. That's right. No,
yeah,
I'm
Well,
looking
well,
forward
the
to that. I'm
well
looking forward to that.
the other narrative that is coming out of China is the out of the West anyway is that they're asserting that there's deflation in China, and that's the worst thing in the world. I keep seeing those types of headlines pop up over the last.
yeah,
Yeah.
If you have any
yeah.
thoughts
No,
on
that's a great
those?
point. Well, wouldn't those are nice problems to have,
Yeah, you would
deflation.
think, but that's not how
Yeah.
they're framed.
Yeah. Yeah.
Oh,
Well, look, I mean, a couple of things that I've noticed is on that topic of deflation. I've noticed, I think I just wrote about it in the newsletter actually. I noticed that China's money growth has changed considerably over the last 10 years, which is really why it's unraveling, right? Why their past bubbles are unraveling now. Um, if you look at it, we'll post a chart here for subscribers here, but the money growth rate for M1, I think it was for most of China's history, as far back as I think I saw 50 or 60 years of history, it was between 10 and 30% a year annually. The long-term average growth rate is basically twice the American inflation rate in money, right? So
mhm.
they're traditionally very easy, and we know that they created the malinvestments that they had because of this, but now they've changed that policy up. Now they're growing money at below 5% per annum. I think it was like I think they're down to about 1 or 2%, a crawling pace, right? Which is the source of the, if you want to call it deflation, I guess, right? The source of the unraveling of their bubbles, the deflationary pressures, even though they're not really running a deflation policy like the Fed is at the moment. They've been for a long time, for the last 10 years, running a very non-inflationary monetary policy, and so they're bringing everything down to reality, which is that's a
Right.
good thing. So that's interesting to me. That's a good
Yeah.
thing. And the other thing that comes to mind with the introduction of the BRICS currencies, it's not just the currency. It'll be like a League of Nations they want to create, right? And I'm not saying that's a good thing, it's a globalist thing, but what's good about it is that because it'll check the authoritarian nature, it'll check the authoritarian nature of China, because if they want to be in a situation where they're deal makers and they've got all these arrangements, it's not a good idea to use authoritarianism and force, because those are deal breakers, right?
Right.
So just trying to manage creating a new currency block, that itself will probably check their authoritarian impulses somewhat, I think. So those are two things that come to my mind as potential positives. I don't know. But I'm very suspicious, like just for, like you say, for the bumper sticker case is just too real for me. The authoritarian nature of the fact that it's not even just, I mean, it's a party. It's not just one guy. So if he goes, the party is still a communist party, and it's not but my biggest fear historically is when they started to liberalize in China in the 90s. I thought that was great, but I also worried that the first wave was going to cause a reaction. And the reaction was, I mean, it's there. The state has, the state was a failed state, and then now it's regrouped because the country has produced all this wealth under the non-restrictive environment of a failed state, right? And so now the state is sort of entrenching itself again. So I don't like that, right? That kind of makes me nervous. But like I said, they seem to be they don't seem to be bellicose, at least not yet.
No.
Maybe
they're not bellicose. They're not imperialistic,
right?
Like the U.S. They don't have the cultural bubble that we have. They don't have the bond bubble that we have. They don't have the inflation that we have.
Right.
There's a lot, and they don't have the excessive valuations that we have. I mean, Alibaba is trading at 7 or 8 times forward earnings. This is a company that has, it's the second largest finance company, I think, after Visa, and we're not even talking about their e-commerce operations or their cloud operations. And also, the other thing is the balance sheets. I don't think people realize just what kind of shape the balance sheets are in and how much cash is there. So at Alibaba, they've got over 40% of the stock price in cash. And I got interested in China. Like I said, I used to be bearish. I used to be, really very bearish on China. And this was back in 21, I think. I think it was 2021, when the government cracked down on the education, the private tutoring business. And New Oriental is the biggest of the tutoring companies, private tutoring companies, and the stock got, it was a darling for a long time. The stock got absolutely destroyed, and the feeling was that this company was going to be, the whole industry would just be put out of business. That was kind of the narrative at the time. And so I remember I recommended it at 20. Of course, it went almost to 10 over the next like 6 months. As typically when you catch falling knives, you get a little bit bloody.
Yeah.
But they had over $1 billion in cash, no debt. They had, I think it was $40 or $50 a share in cash. And so I thought, well, the Chinese, they value education. We know that. This is a leader in the industry. I called it a speculation. I put it in a speculative bucket. But I said, I think this is probably a pretty good speculation. And it's been interesting to see how the company has adapted over that since that happened. They didn't go out of business. Their revenue, of course, went down. It got more than cut in half. They were losing money for a little while, but it's been interesting just to watch, every single earnings report, the company has come back, revenues are almost back to where they were. The business has changed, they've adapted. And, to me, the stock is now, it's an $80 stock, from 20. And if I should have bought more at 10 and change. But to me, that's kind of a little bit of a lesson in terms of how entrepreneurial the Chinese are, how they will adapt. I think this is a very competitive culture, a very competitive economy. And if I'm kind of ranking, I think that they are more entrepreneurial and more competitive than the U.S. economy.
Yeah,
I would say the U.S. I'm sorry.
I would agree that on an individual basis, yeah, in my experience,
Yeah. Taking the government out of it. I'm not a fan of government, but I mean, just I'm investing in, hopefully investing in people and culture.
I think we're on the line. Are we on the line with racism here by saying that, that the Chinese are more
hardworking,
industrious than the average American? Is that
entrepreneurial? I don't. Yeah, and I also think that the U.S. is still a leader in terms of innovation, but China is probably a lot closer, I think, than people realize.
Sure.
And the one thing. So I want to go back to the late 1980s. I was very early in my career back then, so I'm dating myself a little bit. But there was something. This reminds me a lot about the late 1980s, and I look at over my career what I've experienced. There have been maybe 4 or 5 major inflection points. I wasn't in the business in 1982, 1981, but that clearly was like the mother of all inflection points. That was the beginning of the whole bond boom, stock boom. But then you had really, the late 1980s were a major inflection point because you had you had the Japan bubble, which peaked in 1989. You had the United States just came off the 87 crash. Everything bottomed in really, 1989, 1990. So it was a major inflection point. If you looked at that narrative, it was all about America was going into decline, and it was all about Japan's rise. And a lot of the people that were promoting this, going back to the Austrian framework, they were interventionists. They were Keynesians. They were people like Lester Thoreau, who was an economist at MIT, and got a lot of TV time promoting this whole narrative that like all empires, the American empire was going into decline, and the baton was being just passed to the Japanese. And I remember at the time I just had discovered Austrian economics in 1989, and I just started reading Murray Rothbard's book, America's Great Depression, and I started to connect those dots in terms of, this is, easy money has inflated this giant bubble. They have this real estate bubble, and which was completely nuts, and they had this stock market bubble. But also, I had the contrarian instincts back then, and my thinking was that this narrative, when it's so one-sided, and you're just over and over every day, you get up, you read the Wall Street Journal, it's all about America's decline. And my thinking was, okay, this narrative isn't going to be just off by a little bit. This narrative is probably going to be off by 180 degrees because the crowd is so far on one side of the boat that the opposite is there's a good chance that the opposite is going to happen. And so bringing that forward to today, it reminds me very much of China and the United States, except that in this case, China is where we were in, let's say, 1989, 1990, and the United States is where Japan was in. Now, it's not a perfect. I'm not, history doesn't repeat. It rhymes. Okay, I know it's not a perfect comparison, but when I look back in
what you're
1989,
what you're trying to say, I think, is that the story the narrative right now about China are way early. Is that what you're trying to say?
well, okay, so I'm saying a couple things. Number one, it's this idea of American exceptionalism. This goes back to the imperial bubble. The fact that the U.S. makes up 60 to 70% of the world's equity market capitalization. Okay, if we go back to 1989, Japan made up, it was over 50%, which was remarkable for the second biggest economy at the time. All right, and so the bet and the United States was very much undervalued, especially U.S. technology stocks back then. And I remember Dell. We invested in Dell Computer. It was trading. This is when they traded fractions. They didn't have decimals.
I mean, geez, Microsoft. I think Microsoft was so like a penny stock in the early 80s.
Well, I don't know that it was a penny stock. Are you talking about adjusting for all the stock splits?
Yes.
Okay.
Yes.
Yeah. Well, right.
I think
right.
But it wasn't the same.
No, these stocks were incredibly cheap. Dell traded for, I remember we owned it at book value, and it had a third of the stock price in cash, no debt. And the reason it was that cheap was that the margins were depressed because they overpaid for some memory chips. But as they came out of that, they were profitable, and the stock was trading at 10 or 12 times earnings for a good part of the at least the first half of the 1990s. So yeah, there were a lot of bargains, and that's all I'm saying is if you kind of sift through China. So I'm really saying two things. One is that I just don't think that that the U.S. at 60 to 70% of the world's market cap is sustainable. Okay, that's one thing. And the second thing is that this narrative about China, I think, has the potential. I don't know the future. I'm a betting man, but I think there's a decent chance that the narrative about China is 180 degrees wrong, like it was with Japan, and that if we look out 10 years, China is going to be far more advanced technologically than I think anybody gives them credit. And it's happening already. I mean, I don't want to give away my whole talk, but there's evidence of this just all over the place.
So let me ask you, just to keep us from going on too long, I guess, on this video, right? But let me ask you, if somebody wanted to buy some of these Chinese stocks, now, first of all, so you have a couple things going on. You have your hedge fund, right? Which is that the core fund?
Yes, the Barron Core Fund.
And then you have the coffee can portfolio. Is that just for the newsletter?
That's right. So I actually track a model portfolio in the newsletter.
Okay. And is there overlap between that and?
Oh yeah, absolutely. Yeah. I mean, if I like an idea, I'm invested in it.
Okay.
Absolutely.
Can anybody buy into your hedge fund, or are you restricted in any ways?
Yeah, restricted to accredited investors.
Okay. And that's $500,000 in income or net worth. I can't remember exactly.
Yeah, net worth has to be over $1 million, exclusive of residence. You can also qualify if you meet a certain income threshold, right?
Okay. And do you have okay? So, and you have all the forms if and so on. So we'll have maybe we'll have a link down to your website here.
Right. I've got two websites. One for Barron Asset Management, the other for the coffee can portfolio.
Right. Perfect. Okay. All right, super. And so what is the best way to buy into these things? Should we just buy your hedge fund, or can we buy stocks directly
Oh,
through?
you can buy, yeah. So, in terms of investing in China,
Yeah.
yeah. So, really, I think of China as there's really, in my mind, three different ways that you can invest in China. One is if invest slash bet on the future of China. Okay. One would be just as a consumer of commodities and figuring, I think that the property bubble has burst, and so I might want to avoid some of the industrial commodities, industrial metals, but think in terms of the kinds of commodities that a growing China economy would consume. And we know that there's been this incredible underinvestment in the resource area. So it's just you're going to have that additional tailwind. That would be one way. It's not a direct way, but I think that's pretty safe. The second way, the way that I really like is, if you um, there is this VIE variable. I'm drawing a blank, but the structure of the Chinese ADRs, that some people are going to have concerns about that. Okay, it's a risk. I'm not going to say that there is no risk there. Okay, so if you don't want to invest directly in Chinese stocks, the beauty of it is that there are all kinds of businesses, whether a lot of American businesses, Lululemon. I'm not recommending Lululemon, but that's Canadian. They're doing phenomenally well in China. There are all kinds of Western companies that do business in China, and you'd be surprised. We found some of these retailers that they do more business overseas, not just in China, but overseas than they do in the United States. And they're cheap, and they're not cheap, but I mean they're very reasonably priced.
Are
So
they? That was my question.
that would be
Are they cheap, or can you buy U.S. stocks that do business in China at a
well,
fairly
it depends. You
reasonable
just got to go
valuation?
one by one. So Nike is not cheap, and
No.
Nike also we talked about the cultural bubble. I and the woke index that I developed. Well, Nike is one of the 5 companies in the woke index, along with Disney, and so I just look at that as these woke cultures as a risk that I'm not willing to take. The valuations are there's no comparison at all. So really, those are the three ways. I mean, I think you can do it indirectly with companies that do business in China, and I'll name a few of those in my talk, and then also directly in some of these Chinese stocks like Alibaba. I mean, I feel pretty good that if you just bought Alibaba and locked it away and got up in 10 years, you're probably going to feel okay about that as an investment.
Let's let's wrap that up. Let's wrap this up. Is there anything that you wanted to kind of put forth on about your hedge fund that we haven't talked about, or about bubbles in general that you want to mention, that you had in mind, that you wanted to leave with us before we wrap up?
I think we covered things pretty darn well. I'm looking over my list here. No, I think we've really covered it. I think what the key with this bubble is this everything bubble. Oh, one thing I probably should say, maybe just in closing, um, and I hope this doesn't get us into a kind of a giant rabbit hole, but uh, I'll risk it anyway. So so one of the things about bubbles, so probably two things I can mention. One is that they are always underpinned by a false belief. Okay, so if we look at the dot-com bubble, for example, well, the internet was 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 absolutely real, and if anything, it was underestimated just how
Right.
big it would impact it would make. So
Right.
there was nothing false about that. The false belief of the dot-com bubble was first mover advantage. It was the idea that the pets.coms And all of these companies that were just rushing in, it was a land grab, land rush. That was the false belief. The false belief of the housing bubble was that real estate always goes up. What makes this bubble fascinating to me is that, like I said, it's part imperial, it's part cultural, part financial. And at the epicenter of this bubble, I think, is the US government bond bubble. And if we look at the malinvestment, I can look at the Magnificent Seven. Is Apple really malinvestment? Are some of these companies like Amazon, is it really malinvestment? No, I mean, they're overpriced stocks, but they're, amazing, incredible companies. And they're just, they probably have maybe 50% downside, but the real malinvestment here is really the US government, and just keep continuing to pour money into this. That's where the malinvestment is. So I'm looking at this, and also the imperial bubble. So I believe that the false belief of this giant everything bubble is the idea of government as universal problem solver.
I like that
And
one.
that is what, as this thing bursts,
that's one hell of a progressive bubble.
Yeah, and also I believe that bubbles mark major turning points, major inflection
I
points.
agree with you though, Kevin. I really like that one, because that is something that I just every single day it's just, if only people stopped looking to the government for a solution to every fucking problem that comes their way. If only that, then that, right? That would be great.
Yeah. But also the bubbles reverse. So the trend, the unsustainability, we talked about booms and manias and bubbles. The thing about a bubble is that it's not sustainable. It's resting on a false belief, and it typically reverses at least the excesses and the unsustainable part of the boom. And so I'm looking at what is this trend that we are reversing. And I think the trend is a more than 2-century trend in centralization. And I think it got started, this is probably going to be a little bit controversial, but it's got started with the signing of the Constitution in 1789, and replacing the Articles of Confederation, and really the victory of the Federalist vision, the Hamiltonian vision, as opposed to the more decentralized Jeffersonian vision.
That's right.
And we've had many episodes along the way that have led to greater and greater centralization. And I think that
the Civil War was one of the peaks in that bubble, right?
Absolutely. The Civil War was, I mean, the Civil War, imagine
the war between the states, if I want to be not
the
too
war of northern aggression.
That's right.
I'm right here in Pennsylvania. I'm in my safe space right now. I can say that. But no, that was, so imagine if the South is able to secede from the Union. It basically stops this trend of centralization right in its tracks. So in order for that trend to continue, the North, Lincoln had to do what he did. And I know Tom DiLorenzo has called Lincoln, he says he's not the great emancipator, he's the great centralizer. So the Civil War certainly put the United States on a path towards this, great centralized government. We had the inflation that took place, the greenbacks of the Civil War. You had, all of it paved the way to what we have, what we got later with the central bank. That was really an earlier experiment.
Well,
it was
1913,
kind of the predecessor.
Tom DiLorenzo called it the Revolution of 1913, right? It was the culmination of that whole progressive agenda was 1913, and that's when we had. That's when
And
they
so
end.
we've gotten many important episodes along the way. Civil War, I think 1893, when we had basically, okay, we'd gone across the country and now we're out of room. What do we do next? Well, there's Hawaii. So let's topple the Hawaiian monarchy, and then now we're off on the path to imperialism. And so, yes, there have been these episodes along the way, and but I really feel like COVID was that catalyst. It was the spark at the end that that blew the top off this bubble, and now we're reversing this more than 2 century trend in centralization. And what we're going to end up with is smaller, ultimately, I mean, believe it or not, smaller government and government on in retreat.
When I look at the stock market, for all intents and purposes, I see the peak as having occurred at the end of 21, and I think what we're experiencing now is sort of an accentuated bear market rally that's based on two delusions: denial that the bull market has ended, and the other delusion is the expectation that interest rates are going to go back to zero, right, or two, or whatever. I mean, the bond yield has already dropped from the 5% level down to 4%.
Right.
So, maybe the Fed can come down to 4%. But I mean, I'm making the case also that that the reason the interest rate is up in the first place is because they've been destroying a lot of credit, and there's no savings to replenish or to replace the credit from the supply side that has been withdrawn from the market. But at the same time, you have government, everybody's continuing to spend beyond their means. The government, businesses, anybody who's got any malinvestments have been holding out because the Fed says it's going to be a slowdown, so don't worry. So I think a lot of people have put off hard decisions because of the way the Fed has managed their expectations. So I see the stock market sort of in this phase where it's in this bear market denial rally, and maybe it'll pop when people in the next few months, when people start to realize that interest rates really aren't going to come down, and then you get a different shift in psychology if a bear market comes about, which I think it will, in the U.S. anyways, and you get a different shift in psychology, because I think for the last 15 years or so, you've had an enormous amount of reinforcement on every dip you buy. Right. So that's why, in my opinion, the psychology is sort of lagging the peak in fundamentals that I think we've observed. Right.
Yeah, and I think that is important. That it always really happens that way. I mean, the sentiment, you're going to get the extreme at the top, but conditions change, and yet you still have this. This first part is denial, and you still have very elevated sentiment in terms of the optimism. So it's not until sentiment has to change, but by the time sentiment changes, it's not. So the cause and effect is changing sentiment does not cause the market to go down. If the market conditions have to change, and the market almost has to go down to change the sentiment. So the sentiment is really, I kind of look at it more as the last thing to change. But I think, and people, like you said, Ed, you made an important point, is the reinforcement that's been going on for such a long time, and that is something that's going to be very difficult to break. Everybody is basically they're going to be fighting the last war. So it's kind of interesting that this rally, of course, it was just the knee-jerk reaction was to jump into the same stocks, but there are definitely some cracks. When you look at the Magnificent Seven, today was kind of interesting because we had several of these companies report earnings, and they're off to the races. Meta, I think was up 14.5%, and Amazon was up 9.5%. But also Amazon's results were good. Everybody is spending, like you said. The consumer is still kind of in denial of this reality that's taken place. But there are cracks in. I think if you look at Apple and Tesla, of the seven stocks, Tesla's results were horrible. Their gross profits were down in the fourth quarter. They were down 22%, I think, and a lot of this is the competition in China. And then you look at the results that Apple came in with today. Revenues were up 2%. And this was exciting because this was the first time they had positive year-over-year revenue in quite some time. But in China, they were down 11%. And they were up against a really easy comparison. So, the competition, they're competitively, they're getting hurt there as well. So those are just, if I were making a list of companies that I would be, concerned about, sort of, if you're looking for cracks in this bubble, in the Magnificent Seven bubble, maybe we start with Tesla and Apple that have gotten absolutely destroyed. I mean, so those stocks are already down 89, the Pelotons of the world. They're down 80, 90%, and they're on the mat and they're not coming back. That's very much, like the .com part of the bubble. But then you have this other, like you said, real companies. And that's really what we're experiencing today. It's that almost that echo bubble in companies that will be around. Apple will be, they're not going out of business in 10 years. Yeah. But are they going to be able to, what kind of return will investors get? And it could be a very long slog of not going anywhere or maybe losing money.
Yeah, I mean, we've seen the clean energy stocks get destroyed too in the last couple of years. That's for sure.
That's another pocket of malinvestment, right?
Yeah,
which is
an
interesting piece to the puzzle.
One of the stocks that went down after I don't know if we could say it was caused by the bust in the .com bubble, but it probably was, because the 90s was sort of a peak moment for it, was GE. You remember? GE was one of the last stocks that was in the Dow at its inception that left the Dow. So I don't think there's any stocks left in the Dow today that existed when the Dow was created anymore. I think GE was the last of that breed, right? Yeah, it's interesting. Okay, so
I just wanted to hop in there real quick on that subject of the bigger boom and how we can talk about stocks a lot, but if this whole kind of mania is going to end, I feel like it has to end with the U.S. government can't spend any more money. And I feel like the interest payments we're making right now, like we're hitting the end of the road, and it just seems like no one cares about that. So it's like, when do people care? That's
a good point. The political battle over that hasn't really even started.
It hasn't. But the second thing about that is, what's surprising me is that despite inflation, despite rates and our debt situation, people are still buying U.S. treasuries. Like, there's still some demand. Yeah, they might demand higher rates, but people are still buying those. And I'm curious what Kevin's experience, kind of an insider look into the treasury market, and why it's not reflecting reality, in my opinion.
And yeah, my answer would be 39 years of reinforcing behavior, and that, the muscle memory is there, and people are expecting the past to continue. They don't see that there's been a major shift, and they're not connecting the dots. So, sentiment is still way too complacent. And, in terms of what what stops all this is basically the money's not there. I mean, if interest rates just stay at these levels, I mean, heaven forbid they go up even more. If they go up more, the whole banking system, I think, is already insolvent. Okay, I
Me
did a
too.
deep dive on this back after the problems at SVB, and the interest rate losses are very real. They haven't gone away. And just imagine, so it's not just these government securities that are not marked to market. It's also the loan books. So, we don't, the regulators, again, they didn't
That's
plan
right.
for this, but
Mhm.
the reality is that if you make a if you make a mortgage loan at 3%,
Yeah.
which they were doing, and interest rates go to 6%, and they're
Yeah.
now higher than that on the
Yeah.
30-year. It
You're
means on
underwater.
paper,
Yeah,
you've lost the net present value is down by 40%.
that's
Okay.
right.
I can tell you that is not reflected. If you just do the math, it's not just, the regionals, it's everybody. Everybody was doing the same thing. There was very little hedging going on. And so, yeah, interest rates can bring this all, a lot of things. I think maybe this is the theme of what we've all talked about. These things are all interconnected. The dominoes, any one domino can tip over another one. Anything can be a catalyst to sort of bringing things down.
Mm.
And, as far as people are going to have to make choices. They're going to have to choose between, do we finance, fund wars in Ukraine and pour money into the Middle East and fight trade wars with China, or are we going to collect our Social Security benefits? And I think this is just the new reality. And then on top of this, you've got where young people sit in all this, because they're going to be asked to pay for it, and not only in terms, and they're getting royally screwed right now because at the beginning of this great bull market, the median in the United States, the median price of a home was 3 times median income. Today it's 6.5 times. And so young people are really, really getting squeezed. And now they're being asked to serve in wars and finance, pay for the baby boomers for their
Yeah, and
retirement.
the old people are getting screwed too. The ones that have not very much in savings and have depended on government pensions and stuff. They're getting largely screwed because
Yeah.
of the price inflation, right? As well, for sure.
Yeah, but economic reality will exert itself. I think that's kind of the theme here.
Yeah.
And it's coming. It's just that the people that are, in Washington, D.C.,
Well, I have one.
Trudeau up in
I,
Canada, they just haven't gotten
totally.
the memo yet, but
Yeah.
it's coming.
Yeah, no kidding. Trudeau is he just thinks the good times are going to keep going, right? But yeah, the one of the things that I wanted to mention was that I found that some people in the current stock market invest, they're hesitant to sell because of the tax situation, and the amount that they get taxed on their gains if they sold. To them, their argument is, well, for me to sell, the stock market would have to fall more than 20% on average, right? And so you could say that the investors, a lot of the owners of shares today, might have that number in their head, thinking, okay, I can withstand a 20 or 25% decline in the stock market. I'm in it for the long term. But you've got boomers that have piled their retirement savings and wealth into the stock market over the last few decades, and all under the delusion of very low interest rates, right? Or the normalizing effect of that on their psychology. And as they approach retirement, which I think is, for the boomer curve, is pretty close. I think a lot of them are probably depending and relying on their stock market wealth to fund their retirement. And so they might say, okay, well, I won't worry about a 20% decline. But then the 20% decline comes, and then, as we know, the psychology will start to turn, right? And then the market will start conditioning people to sell the rallies instead of buying the dips. And then the market's down 40%. And then the boomers start to panic and they start to get nervous. But then you'll have a rally and they'll be okay with it. And then the next dump, they'll be like, okay, I got to get out. The market will be down 50 or 60%. I'm talking about the Dow. And they'll be like, and this is 2 years from now or 3 years from now, and you'll see like a massive outflow of boomer funds, I think, from all these mutual funds at the very bottom of a market cycle. And you're going to see a lot of pain because of that alone, I think, as well.
And really this kind of reminds me of what we started talking about in the beginning of this roundtable discussion, which was envisioning different scenarios. And so, really what you're painting it is just a scenario, very realistic scenario that could play out. And I think, as an investor, you have to just prepare yourself for that. What if this plays out? How, and the reality is that if it does play out, it's going to create opportunities. So you want to at least be prepared for it, and also kind of think in terms of the chess game, playing it out many moves ahead. What am I going to do if this scenario plays out? The good news with these bubbles is that bubbles also spawn anti-bubbles. So we talked about the tech bubble in 2000 in 2000, which really, the first part of that peaked in March of 2000. Well, the value stocks, the old economy value stocks that nobody wanted, they bottomed at the very time that the NASDAQ composite hit 5,000 and peaked.
Right.
Okay, so, and in fact, if you look at the valuations of some of these value stocks over the last 3 decades, a lot of them, the cheapest they ever got was in March of 2000. Now you could go back to, if you went back further to 1990, it might be a little bit different, but that was a major. So, I think this is really super important to understand is that, one of my rules, coffee can rule number 8, I think, is it's a market of stocks, not a stock market. So, I think it's important not to think about the market as this monolithic thing that's, everything's going to go down. Now, it could. We certainly had that in 2008 where everything went down, and you have to prepare for that. But also, just know that what my concern is just finding the best values, the best opportunities out there, and
I think that makes sense.
And where the risks are and avoiding those.
Yeah, that makes a lot of sense, Kevin. I would probably add that when you're scenario building, in the scenario building phase, it's good to think of the situation from the top down, because there's a lot of wins in the macro area, right?
Right.
And so if you think you could even in your scenario building, you could also probably hone in on some sectors that as well, like when you say the tech bubble spurred an anti-bubble, and you're talking about value stocks, I was also thinking about gold stocks and gold, right? Because eventually we had a commodity bubble, right? We had a commodity bubble based on China, on the idea that China was was a big mover in investing in infrastructure and so forth.
Right.
So that's right. Yeah. Anyway, so let's end this talk because it's been on for a long time. I don't know if our viewers have that much of an attention span, but I hope they do, and I hope that you enjoy Acapulco. So nice talking to you.
All right.
Let's leave it at that, and
Okay.
we'll see you soon, I hope.